century of inflation and economic chaos, your dollar just died. It happened right here. Welcome to the deep dive. Today, we are taking a truly monumental trip through more than 100 years of U.S. economic history. Our specific focus is on that single, relentless force that dictates the value of every single dollar you earn: inflation. We've dug deep into historical data going all the way back to 1914, reviewed crucial policy critiques, and analyzed a wealth of modern research to try and figure out what genuinely drives prices up. And perhaps more importantly, how the attempts to fight this economic enemy have often inadvertently created brand new, long-term problems. Our mission is to take these huge, sometimes unsettling numbers and put them into a clear, understandable context. What is CPI? When we talk about inflation, we are talking about a sustained, year-over-year rise in prices. And the official scorecard for this phenomenon is the Consumer Price Index, or CPI. The Bureau of Labor Statistics puts it out, and it measures the price change for a fixed basket of goods, the stuff people buy all the time: groceries, gas, clothing, and rent. For decades, the Federal Reserve's big target, their bedrock goal for stability, has been 2% inflation a year. Just to set the stage for today, the latest numbers we have from September 2025 show the annual rate sitting at 3%. The index itself is at 324.88. We are still running a little hot compared to that 2% goal, which is why looking back at history is so critical right now. When that basket of goods gets more expensive, the inflation rate goes up. And that increase directly reduces the purchasing power of every dollar you hold. That is the real loss we are tracking. The financial whiplash, 1914 to 1921. If you think the last few years have been volatile, we need to jump right into the archives, because the early 20th century saw swings that would give a modern central banker a nightmare. It was a period of financial whiplash. That era registered both the highest and lowest inflation rates in U.S. history. The all-time high was an absolutely astonishing 23.7% in June 1920. This was right after World War I, and prices had surged over 80% in just 4 years. But the whiplash didn't stop there. Prices went into reverse, completely. We hit the record low, a massive deflation of -15.8 just 1 year later in June 1921. Think about that for a moment. Your money loses almost a quarter of its value 1 year, and then the next, prices are collapsing by 15. That's economic chaos for any business trying to plan, or any family trying to save. These early extremes were almost always connected to war. But the deeper cause wasn't the fighting itself, it was a policy choice. It was a failure of governance. When governments couldn't raise enough through taxes, they simply printed money. This huge growth in the money supply, way beyond actual economic output, created the fuel for those devastating price surges. The compressed spring, post-World War II, 1946-1948, that pattern of wartime intervention brings us right to World War II. During the war, the government imposed strict price controls and rationing on everything: sugar, coffee, even cars and tires. While that kept a lid on inflation during the fighting, it was like a compressed spring. It forced a huge increase in personal savings that was just sitting there, waiting for release. The years 1946 to 1948, immediately following World War II, offer the clearest example of a modern supply shock. The moment those price controls were lifted, the spring uncoiled. You had huge supply shortages meeting a tsunami of pent-up consumer demand. Inflation shot up to 20.1 between March of 1946 and March of 1947. The data on that demand is incredible. Between 1945 and 1949, Americans bought 21.4 million cars and 20 million refrigerators. All of that spending hitting the system at once after years of scarcity. It's no wonder the economy couldn't absorb it without prices exploding. It was a textbook demand pull shock. This episode really shows why government-imposed price controls have a terrible track record. They tend to fail because they are only masking the underlying pressure. A perfect example: the UK in the 1970s tried them, and inflation still hit an annual rate of 30. That failure of direct control is a huge cautionary tale. The greatest policy failure: the Great Inflation 1965-1982. And that brings us right into what the Federal Reserve itself has called the greatest failure of American macroeconomic policy in the post-war period. The Great Inflation. This was an era from 1965 to 1982, where inflation climbed slowly, but surely from 1 all the way up to nearly 15. How did that disaster go on for 17 years? Well, for something to last that long, you need a few things to go wrong at once. You can break it down into motive, means, and opportunity. Motive. The Phillips Curve myth: what was driving policymakers to let prices run hot for so long? The motive was a disastrous belief in something called the Phillips Curve. Policymakers genuinely thought they could buy permanently lower unemployment by just accepting a little bit more inflation, a trade-off that turned out to be a complete myth. Economists like Phelps and Friedman were warning against it, saying, once people expect inflation, you'll need more and more of it just to keep unemployment down. It was a false bargain, so they had a flawed goal. What gave them the means to chase it? The means was the collapse of the Bretton Woods system in the early 70s. That system had tenuously linked the US dollar to gold. When it fell apart, it severed the last real anchor on the money supply. The Fed could print without immediate international consequence. It allowed the money supply to accelerate. Opportunity, external shocks, and then came the opportunity, the external shocks. Precisely. The opportunity was geopolitical. You had 2 massive energy crises: the OPEC embargo in 1973 and the Iranian Revolution in 1979. These oil shocks drove energy and food costs through the roof. That toxic mix locked the economy into stagflation: high inflation, high unemployment, and slow growth. Just brutal. The Volcker shock, the only thing that broke that cycle, was a really severe intervention. When Fed Chair Paul Volcker came in 1979, he made an extraordinary choice. He decided to prioritize inflation control over everything else, over employment, over growth, at any cost. He did it by aggressively tightening monetary policy. He had to regain the Fed's credibility, and he did. He successfully crushed inflation, pushing it down below 5. But it came at a very high price. He basically engineered a massive recession in 1981 and 1982 to reset everyone's expectations. The human cost was severe. Unemployment shot up towards 11, the highest it had been since the Great Depression. Millions of people lost their jobs. The trade-off was explicit: short-term pain for long-term stability. That move did pave the way for decades of relative calm, the so-called Great Moderation. A modern paradox, QE and the canyon effect, but that calm ended, and it ended very abruptly with the pandemic. Let's jump to the recent past, the 2020 to 2022 inflation spike. We hit 9.1 in June 2022, a level we hadn't seen since Volcker's time. The initial cause was a familiar mix: supply chain disruptions from factories shutting down globally, meeting a huge surge in consumer demand as things opened back up. The crucial difference this time, the really big factor, was the central bank's response, specifically quantitative easing, or QE. The scale of this is hard to wrap your head around. The Fed printed $4.5 trillion between 2020 and 2022, doubled its balance sheet from $4 trillion to almost $9 trillion in just 2 years. The controversy isn't just about the amount of money, it's about where that money went. That new cash didn't just show up in your bank account. It went into the financial system, to banks and other institutions. And what did they do with all that cheap cash? They bought assets, stocks, real estate. The consequence was predictable: asset price inflation. The median U.S. home price surged 30 in less than 3 years, while wages went up, 5 to 7%. created a massive transfer of wealth. This brings us to the key issue for most people listening: the huge gap between the official CPI number and their actual, lived experience of inflation. That is the heart of it. The overall CPI has slowed down. It was 3 in September 2025. The stuff you have to buy, the non-negotiables like housing, food, and energy, often rose much, much faster. We all saw it. Used cars jumped 40 in 2021. Egg prices went up over 70 at one point. And it's not the same everywhere either. Inflation isn't one single national number, it varies wildly by city. Our sources show San Diego, for example, had an average rate of 3.41 over 30 years, compared to St. Louis at just 2.04. So why the disparity? It's a phenomenon some people call the canyon effect. The people who are closest to the source of the new money, the banks, the asset owners, they benefit the most because they get to spend it before prices have gone up. They deploy that new capital into investments before the inflation has trickled through the whole economy. To put it simply, if you're a banker buying assets with fresh cash, you win. But if you're a wage earner in, say, St. Louis, and you're waiting for that money to trickle down to you through a pay raise, by then it's too late. The cost of your housing and your groceries has already shot up. You have lost ground. Data on this is brutal. Between 2020 and 2022, the wealthiest 10 of Americans captured 6 times more wealth than the bottom 50. A huge part of that was this asset price inflation from QE. So when we look back over this whole century of economic chaos, a pretty clear pattern emerges. Inflation seems less about simple economic growth and more about political and policy choices. Choices around massive money creation, whether it's for a war, chasing flawed employment goals, or responding to a supply shock with just overwhelming amounts of cash. And this process seems to inevitably lead to these huge, often painful wealth transfers. That is the core lesson here. High inflation destabilizes everything, and the Fed sees its primary job as anchoring that annual rate around 2. Challenge is never if they can control the money supply, but how they do it without causing those harmful side effects, like the wealth gap we just talked about, or a brutal recession like the one Volcker engineered. Volcker's entire success really relied on one thing: convincing the public that the Fed was credible, that it would stick to its guns no matter what. He had to break the public's expectation of high inflation. Given that long-term inflation forecasts for 2026 and 2027 are still projected a bit above that 2 target, 2.6 and 2.4, it leaves us with a final thought for you to mull over. What level of confidence is actually required for businesses, and for you to truly look past all these ongoing economic shocks and keep your long-term price expectations permanently anchored at 2? And after a century of such extreme volatility, is that level of deep, unwavering confidence even achievable anymore?
Found this interesting? Subscribe to the channel. Give this video a like, share it out, and drop your questions or ideas in the comments. Until our next adventure.